Good morning, everyone. So my name is Shivani Dasani, and with me here, as Adam mentioned, I have Adam Grimsley, who is the head of investment solutions at Prime Factor Capital, and I have George McDonough, who is the CEO and founder of KR1. Welcome, gentlemen.
Thank you.
So as you're aware, this session is focused on cryptocurrency and hedge funds and how we can go about unlocking that source of capital in order to deploy to the asset class and some of the dynamics that are sort of involved with doing so. Obviously a highly relevant topic. So Adam and George, tell us, are investors actually buying crypto, and if so, in what magnitude?
Perfect.
Yeah, yes, they are. They are certainly buying. It's difficult to kind of unravel how much they're buying and who's buying it, because there's a mixture of methodologies for actually purchasing crypto. I mean, you can do OTC, avoiding the secondary markets, so it doesn't actually impact a lot of price action. But there are certainly people buying, and there's a huge desire. There's a big amount of desire to purchase this asset class. They get it. They're very smart people. And there's one thing that really kind of stings institutional investors, and certainly some very kind of bullish investors, is that they missed out on it first time round. And that must be a hell of a kick in the guts if you pride yourself as being one of the great luminaries of picking venture capital, picking the new wave of kind of investments, and you completely miss it the first time round. There's a desire not to miss that second wave, and I think that certainly is in evidence.
Yeah, I'd agree with all of that. So someone recently described it as a gigantic game of musical chairs. And when the music stops, they'll all sit down. Right. And then someone said, well, Yale just sat down before the music stopped. So we did see the Yale Endowment Fund put in sizable sums of money to crypto funds. And I think that's been really interesting from a sort of bellwether perspective in terms of looking at the general sense of how very sophisticated institutions are seeing this asset class. And I think people will follow that lead of what Yale have done, amongst other things like Fidelity and Gemini, Goldman Sachs, and various other big names that are also moving into the space.
Right.
Yeah. It's a race which everyone wants to be second. There's loads of these great little analogies and so forth, and it's absolutely right. If last year was about price action, actually, the lack of the replication of that price action has actually allowed us to take a bit of a pause for institutional investors and to other people and the infrastructure to catch up a little bit. We've seen, if you look at the fundamentals, I don't think a huge amount has changed. Arguably, it's got a lot better than when the price was at 20,000 for Bitcoin. So, there's a great opportunity to reset and re-go.
Re-go, yeah. And what do you think are some of the criteria and parameters that the crypto market needs to instill in order to make it an investable asset and to allow institutional investors to actually get more comfortable and invest?
Yeah, I think they get the investment case. I really do. There's huge smart people now. I mean, I go talk to some of my kind of buddies back in the city, and they know a lot about this asset class. But the investment case is only one part of the puzzle for institutional investors. They are fiduciaries in terms of that. It's not their own capital they're putting to lay. So there's this huge element of, can we do it? There's a lot of gatekeepers on that process of actually deploying capital from an interesting investment perspective in terms of, people's talked about the custody. I'm not going to go on about custody. I think that subject's been done to death a little bit. But that's really gone leaps and bounds. Valuation, metrics, all these kind of things, framing it in a really recognized risk-reward framework, which is incredibly important to these investors, and looking at how does it fit into the whole portfolio as a whole. They don't look at just one asset class individually. It's about constructing an overall portfolio to meet the capital requirements deriving from that portfolio, or matching liabilities, and answering those questions and having those ready answers in a familiar vehicle. There's somewhat of an irony in certain institutional investors if they want revolutionary returns from very familiar ways of investing, and usually you don't get that until a lot of the returns have been taken out of the potential for the asset class. So we're still in that element, and so for those kind of conflicting factors. But we're certainly getting there, I think, with the level of services and new ways for investors to actually access this market.
So you have seen an evolution and sort of a migration that's gotten people more comfortable and just more able to invest in this space.
Yeah, there certainly are. There's a new realm of investment products which tick those boxes.
Yeah.
In terms of having regulation, being authorized manager, being authorized by the FCA or by SEC or something like this. These kind of the real, hurdles which, if they're not fulfilled, no institutional real investor is going to deploy serious capital.
Right, right. And George, you and I talked about this earlier about sort of the dichotomy that exists between institutional investor money and really the ownership of open source networks. Can you tell us a little bit about that?
Yeah, sure. I think it's a really interesting way of owning a network, as a network token. And it's very different to owning equity, which equity effectively you own IP in a company. Well, in open source decentralized applications, there's no IP as such. What I guess you could say the application could be copied 1,000 times or more because it's available to everyone. So really all that matters is which application is being used at that particular time. We're talking more here about the utility token space than the cryptocurrency space like Bitcoin and Zcash, which is slightly different. But as I see it, these asset managers are looking at both areas quite deeply. They're looking at the utility token space and the cryptocurrency space, and they're fairly similar. But yeah, so what does it mean to buy a token? What is it that you're getting? And I think from an investment perspective, it's really fascinating because you have this strange mixture of network effects. Tokens create network effects. So is it more important to get into the application at the very beginning, the one that gets the network effect? So then one asks themselves the question, well, if it gets the network effect and all these applications are open source, if something comes along that's 1,000 times better, well, everything becomes 1,000 times better because that code can be shared. So again, it's the network effect that really matters. So from KR1's a venture capital company, we place finance into very early seed stage companies. And there is this sense that sometimes you feel like you're backing the final one, which is a very exciting feeling to get. This might not necessarily be the case, but it's very difficult to see how once these networks get a real network effect,
right,
how they get taken over. I mean, take Bitcoin as an example. I mean, we had 2,000 Bitcoin clones in the early sort of 2011, 2012, and they all had turn the dial slightly differently. Some had better block times, some had different security, and yet here we are with Bitcoin still there at 50%, 50, 60% of the network, the overall network of the space. So so I think it's a sort of mind shift from some of the legacy investment world as to how to understand tokens and networks and the potential of this space to revolutionize how investing happens.
And do we think that institutional inflows of capital is a positive for this space? And how does that pair with the dream of having, a decentralized asset class?
Yeah, it depends, I suppose, on your starting point and what your end goal is. If you're looking for a market which has better support levels, and a different mixture of investors, which isn't driven by kind of a more retail herd sentiment, then absolutely. That's a function of a mature market where you have a diverse mixture of different investors with different triggers to buying and selling. So there's a bit of price stability there. If your dream is to kind of bring down a kind of cypherpunk, bring down kind of intermediaries and to have this truly decentralized, then you think that the large institutions and so forth entering the space is a negative. So, I'm not going to say which one is better. It depends on what you want. But from an investment point of view, they bring a lot of capital. They bring a lot of innovation. They're building a lot of trust as well in the market, you know, somewhat ironically, because they do have systems and processes which give other investors a confidence. And one, as kind of George was saying, you know, it's a kind of a cliff edge a little bit. When one goes in, a lot of others you'll see build up, and we've seen that this year. Yeah. So from an investment point of view, certainly at this point in time, you'd welcome an inflow of a few large, big market participants. And I don't think we're far off that, honestly. I think there's a lot of things which are going on in the background and infrastructure which can lead to some of that investment coming soon. In which form it comes, I'm not entirely sure, either it be in kind of more venture capital stage, an early stage, or into kind of cryptocurrencies as some of the endowments have put in. It's difficult to say, but it's likely to be kind of a mixture.
And George, what's your sense?
Yeah, I think there is a danger that you know, they call it rehypothecation. You can end up with more paper flying around with a claim on Bitcoin than there is Bitcoin in circulation. So something like that is very dangerous, and we generally aren't very good at stopping ourselves doing that. But in terms of the sort of the network utility world, you can't help but participate in the networks. You can't buy a network. You know, to buy the 100th percentile token of a project, you've killed the network. And I think that's something that some of the very, very large, powerful institutions in the world are going to have to get used to, in the fact that, you know, they will be participants. And some of these applications are so disruptive to centralized offerings that eventually I think there will be no choice but some of these major institutions just have to become participants in the network. And it does depend on the size of the network as well. So if you have a lot of money, you can cause problems, but I think by the time some of these applications become big, they'll have no choice but just to step in line with everyone else.
I think that's a good point. I mean, participation for these large financial institutions, for example, doesn't necessarily mean just buying or investing in that pure sense. A lot of these are looking at it from their back office point of view, in terms of integrating it into their whole business model as a whole. So it's a kind of a back way in, a little bit into these financial institutions and large mammoth kind of places of looking. They're really looking at the way that they can do that kind of back office stuff, which is about, you know, replication of loads of different ledgers, looking at errors, you know, trade settlement, all that stuff that the back office do that they don't really want to do. They see it as low value add and eating into their margins, which is the real high value kind of value add. So there's this kind of interesting balance actually, you know, so you talk to people, they're looking at, say, okay, right, so how is BlackRock, my old house, looking at it, looking at crypto? They're looking at it from an investment point of view, perhaps, but they're also most definitely looking at it, how it can integrate in their systems, how it kind of improve their margins.
And if, in your experience, what is one of the main reasons why funds actually don't invest?
Why funds don't invest?
They just don't want to take the risk. Why? What would be the 2 reasons why?
I still think it's very early stage. Right? I think we saw that with, you know, kind of Rubini kind of criticizing the crypto market. It's a bit like, you know, it's a bit like me having, you know, having a go at my 7-year-old nephew for not, you know, still living at home and not paying any rent. We're incredibly early in this space. So I think there's a real, you know, feel that it's very early and infrastructure is still coming online. So there's real kind of fundamentals. Plus there is education as well. And it's, you know, and that is difficult for even someone who is deeply immersed in this space because things change very rapidly. I mean, the information set from, you know, 6 months ago is very different from the information set we have now. So you can feel yourself, you know, stepping in a constantly flowing river. Right. So, you know, so I think the answer is probably actually everything in some respects, but there are huge drivers which tag along, and that's what makes it so interesting, and what makes the returns possibly so interesting as well for things. It's about deciding where you sit on that spectrum of risk and return. Right.
Yeah, I'd agree with that. All of that. I think it's getting harder and harder for them to ignore. I think, you know, Bitcoin's clearly been one of the best performing assets of the last 5 years, possibly more. Every year that goes by, that it's still there and it's still, you know, churning away the blocks, and it's getting scarcer. And as more people join the network, it becomes harder and harder to tell your LPs why you're not touching it. So I think we're going to see the dam break at some point, and everyone come on board. I think it's perfectly reasonable at the same time to say that it's very volatile, and there are still questions as to how it's stored and the safety of that, and also other things to do with manipulation in the markets.
Right.
It's very scarce, and there's not a lot of floating Bitcoin around to get your hands on, and there's some very, very die-hard holders who will hold on to it no matter what. Yeah. And there's huge amounts of questions, but one of the, as someone said recently on a podcast I listened to, that 0 is the wrong number if you ask whether you're exposed to this asset class or not.
And that tends to have been the mistake over the last few years. People have had either everything in crypto or none at all.
None.
Yeah.
When you talk to kind of professional investors and institutional investors, one of the things is actually about portfolio construction and sizing of your position. Right. It's not yes or no. It's not a binary kind of thing. The amount. It's very nice to have that sit in that alt bucket. And I think they're becoming more and more where they're thinking about, let's just put 1% allocation.
Like leg into it.
Let's leg into this. Put 1% allocation. It's a nice diversifier in the portfolio. It has strong risk-return relationships and so forth, low correlations, all those kind of things. Just thinking about actually modern-day portfolio, they go to Markovits and all these kind of guys. This is old theory stuff. It doesn't matter what asset class it is. It sits very nicely and ticks a lot of those boxes. So even if you don't understand it, it doesn't mean it's not a great investment.
Right. Well, unfortunately, that's all we have time for. Are there any other closing comments you want to leave the audience with?
No.
Well, thank you, everyone, for your time. Hopefully this has been informative.